So you're maybe eyeing Tesla stock. It's a fascinating one, isn't it? Up 1 minute, down the next, and trying to figure out what's really driving it all can feel like a full-time job.
Absolutely. It presents a unique puzzle for anyone thinking about putting their money in. It's not just about cars anymore. You're looking at a whole ecosystem of technologies and ambitious plans, which makes understanding the investment landscape particularly challenging.
That's exactly why we're here. We've got a really detailed investor analysis of Tesla, and we've also taken a good look at Elon Musk's AI company, Grok. Our goal in this deep dive is to boil down the essential factors that should be front of mind if you're considering investing in Tesla.
Right. We want to move beyond just the headlines and the daily stock fluctuations to give you a clearer picture of the underlying dynamics and potential future trajectories that could impact your investment.
Because you've got this duality with Tesla, right? On one side, a major automotive player navigating some, well, serious bumps in the road. On the other, a tech company with these huge, potentially revolutionary projects on the horizon. Okay, let's kick things off with something you hear a lot about when Tesla comes up, the whole meme stock idea. What's the core of that?
At its heart, a meme stock experiences these rapid increases in price and trading volume, largely fueled by social media trends and enthusiasm from individual investors rather than traditional company fundamentals.
Okay.
Think of it as a stock that captures the internet's attention, often driven by a desire to participate in a popular trend or even to challenge established Wall Street players. These stocks are known for their significant price swings.
And Tesla, well, it definitely has a very vocal online following. How does that fit in?
It's a significant piece of the puzzle. As of March 2024, around 43% of Tesla's shares were held by retail investors.
43%. Wow.
Yeah. To put that in perspective, that's considerably higher than what you typically see with more established car companies.
That's a huge base of individual owners, and Elon Musk's X presence is undeniable.
Precisely. Both the company and its leader have a massive and influential online presence. Sentiment analysis, which looks at online data to gauge public feeling around Tesla in April 2025, was generally positive,
right,
though it certainly, fluctuates.
Right.
The sheer volume of online conversations surrounding the stock highlights just how much the narrative can matter.
It's almost like the stock price has its own Twitter feed sometimes. I recall reading about investors really doubling down even when news wasn't great.
That's a classic sign of meme stock behavior, yeah. Early in 2025, despite reports of declining European sales for Tesla even as the broader EV market grew, retail investors collectively poured over $7 billion into the stock in a relatively short period.
$7 billion?
Yeah. Analysts noted this as a significant buying streak, even though those investors were already seeing losses on their Tesla holdings for the year.
That's the diamond hands thing you hear about, right? Hanging firm no matter what the market throws at you.
Exactly. It reflects a strong conviction, often tied to belief in Elon Musk's long-term vision, rather than solely on traditional financial metrics. There can also be an element of, going against the perceived wisdom or even attempting to create a short squeeze.
So, given all this, does that make Tesla a meme stock? Pure and simple.
Well, while Tesla certainly exhibits many of these characteristics, the high retail ownership, the intense social media buzz, price movements that at times seem disconnected from immediate financial results, it's not a pure meme stock.
Okay.
Companies like GameStop or AMC, often cited as prime examples, generally lack the substantial underlying business that Tesla possesses. Tesla has a significant automotive business, a growing energy division, and these, ambitious technology projects.
Okay, so it's a hybrid. It has those elements, but it's anchored by actual businesses.
Precisely. However, these meme characteristics do contribute to its volatility, the fact that its valuation is often higher than traditional automakers, and the unique dynamics of its investor base. This introduces what we call sentiment risk. The stock price can be significantly influenced by online narratives and news cycles. And there's also what some analysts refer to as a Musk premium, or even a discount, depending on how his actions and communications are perceived by the market.
That makes sense. Now let's pivot to the core of Tesla's operations for so long. The automotive division. It feels like the narrative there has shifted noticeably.
It has indeed. After years of being the primary engine of Tesla's growth, the automotive division is currently facing some considerable headwinds.
What does the recent performance actually look like?
In the first quarter of 2025, Tesla delivered 336,681 vehicles worldwide. That was a 13% decrease compared to the same period last year.
13% down.
Yeah. Drilling down, deliveries of their mainstays, the Model 3 and Model Y, totaled 323,800. This actually marked their weakest quarterly performance in the last 2 years. Production also saw a downturn, falling by 16% year over year to 362,615 vehicles.
They mentioned some specific reasons for that dip, if I remember correctly.
Yes, the company attributed it to factory upgrades aimed at the refreshed Model Y, which led to temporary production halts, as well as preparations for the launch of new vehicle models later in 2025.
Okay.
Additionally, lower average selling prices and increased use of sales incentives played a role. This followed a fourth quarter of 2024, where they achieved record deliveries of nearly 496,000 vehicles, yet still fell short of analyst expectations.
Right, even a record wasn't quite enough then.
Exactly. And looking at the full year 2024, their total deliveries were just under 1.79 million, which was actually slightly less than the 1.8 million delivered in 2023. This clearly indicates a flattening of their previously rapid growth trajectory in vehicle sales.
So the period of explosive growth in car sales seems to have hit a plateau, maybe even dipped. What's the financial picture looking like for the automotive side of things?
The financial results directly reflect this slowdown. Automotive revenue in the first quarter of 2025 was just under $14 billion, a significant 20% decrease compared to the $17.38 billion reported in the first quarter of 2024.
20% drop in revenue.
Yes. This also fell short of what analysts were anticipating. Yeah. Perhaps even more critically, their gross profit margins have contracted.
Margins are always a key indicator, aren't they? What did those look like?
Tesla's total GAAP gross margin in Q1 2025 was 16.3%. However, the automotive gross margin, if you exclude the impact of regulatory credits, was considerably lower at just 12.5%.
12.5%, excluding credits.
Right. That's the lowest it's been since the second quarter of 2012. Some analysts have highlighted that their margins are now at a 12-year low, which raises questions about their pricing power and cost structure in a, well, more competitive market.
Regulatory credits, those are essentially payments they receive for selling zero-emission vehicles, which they can then sell to other automakers, right?
Precisely. And in the first quarter of 2025, Tesla recognized a substantial $595 million in these regulatory credits.
Nearly $600 million.
Yeah. The crucial point for investors to note is that without this significant contribution from regulatory credits, Tesla would have actually reported a net loss for the quarter. This increasing reliance on what is essentially a non-core operational revenue stream to maintain overall profitability represents a notable shift from their historical strength as a high-margin automotive business.
So the core auto business isn't profitable on its own right now?
Based on Q1 2025 numbers, excluding those credits, no. We've also observed a downward trend in the average selling prices of their vehicles over time. While there was a recent small increase in the average transaction price for new EVs across the industry in April 2025, the overall pressure on Tesla's pricing remains. This all points to a profitability challenge within their core car business at the moment.
That certainly paints a concerning picture for the automotive division's profitability. What about their position in the market? Are they still the undisputed leader in EV sales?
They are facing intensifying competition, and their once dominant market share is, well, being eroded. In the U.S. EV market, their share has decreased from around 60% back in 2020 to 38% in 2024, and this trend appears to be continuing into 2025.
From 60 to 38%. That's a big drop.
It is. And across 15 European countries, their market share declined from nearly 18% to just over 9% in the first quarter of 2025. Notably, in April 2025, BYD actually outsold Tesla in Europe for the first time.
BYD, the Chinese manufacturer, they're clearly becoming a major global player.
They are indeed. And this underscores the significant competition not only from Chinese manufacturers, but also from traditional automakers who are making substantial investments in their own electric vehicle lineups.
Yeah, everyone's getting into the game now.
Exactly. Looking at the broader U.S. new car market as a whole, Tesla held only a 4% share in 2024. Globally, across all vehicle types, their share in the first quarter of 2025 was just 3.63%.
So still a niche player in the overall auto market.
Relatively speaking, yes. This places them considerably behind established giants like Toyota and Volkswagen. The first mover advantage they once enjoyed in the EV market seems to be diminishing more rapidly than many had anticipated.
So what's the strategy on the vehicle model front? Are they still primarily relying on the Model 3 and Y for volume?
Absolutely. The Model 3 and Model Y continue to represent the vast majority of their deliveries, as we saw in the Q1 2025 numbers. The Model Y is currently undergoing a refresh, which, as we mentioned, has had an impact on production.
Right.
They do have plans to introduce new, more affordable vehicle models, with production expected to begin in the first half of 2025. These new models are expected to leverage some aspects of their existing and next-generation vehicle platforms, which could help with production efficiencies and, cost reduction in the long run.
That sounds crucial for competing on price.
It is. However, the rumored Model Y Lite, which was seen by some as a key component of their strategy to offer more competitively priced vehicles, has reportedly been delayed.
Oh, okay. So a potential setback there. What about their higher-end vehicles and the much-talked-about Cybertruck?
The Model S and Model X continue to be relatively low-volume sellers. In their delivery reports, they are grouped together with the Cybertruck under other models, which total just under 13,000 units in the first quarter of 2025.
So pretty small numbers for those three combined.
Very small compared to the 3 and Y. Elon Musk has even mentioned that they continue to produce these models largely for sentimental reasons. A refresh for the Model S and X is planned for later in 2025.
Sentimental reasons, huh? Okay. And the Cybertruck, how is that ramp-up going?
Its launch has been somewhat complex. The production ramp-up has been slower than initially projected. There were reports of increasing inventory, and they've even started offering discounts on certain configurations.
Discounts already?
Seems so. The approximately 39,000 units sold in 2024 didn't quite live up to the extensive pre-launch hype. Production challenges at their Texas factory and a higher-than-anticipated starting price seem to be contributing factors. They're aiming for higher volume production by 2026.
So it sounds like their hopes for reigniting growth in the automotive division really hinge on the successful introduction and scaling of these new, more affordable models.
That's the critical takeaway for potential investors, I think. They have built significant production capacity, particularly in the United States, but it's not currently being fully utilized. Their stated strategy involves leveraging existing production lines to manufacture these new, lower-cost vehicles.
Right.
Successfully ramping up both the production and the sales of these models will be essential for them to achieve their future volume targets and to benefit from economies of scale, which could help improve those currently pressured profit margins. The current challenges in the automotive segment really underscore the increasing importance of their other business ventures in driving future growth and profitability for the company as a whole.
Okay, that gives us a solid understanding of the automotive side of the business and the challenges they're facing. But as we said at the start, Tesla is evolving into much more than just a car company. Let's now delve into their other technology ventures.
Precisely. Many analysts believe that Tesla's long-term value proposition and its higher valuation are increasingly tied to the success of these non-automotive segments.
Let's start with Tesla Energy, their energy generation and storage business. It seems like that's been a significant area of growth.
It has indeed. In the first quarter of 2025, the energy division reported a very strong 67% year-over-year increase in revenue, reaching $2.73 billion.
67% growth, that's huge.
It really is. Deployments of their energy storage products were also exceptionally strong, reaching 10.4 gigawatt hours, which is a 154% increase compared to the first quarter of 2024.
Wow.
For the entire year of 2024, they deployed 31.4 gigawatts of energy storage, more than double the amount deployed in the previous year. The profitability of this segment has also been robust, with a gross profit of $2.6 billion in 2024 and a margin that has expanded to over 26%.
So it's growing fast and it's profitable.
Exactly. This demonstrates a significant and growing contribution from this part of the business. For an investor, this signals a potentially valuable and diversifying revenue stream.
That's really impressive growth. What are the key products driving this success?
Their utility-scale battery storage system, the Megapack, is experiencing very high demand, often exceeding their current production capacity.
Supply constraint, okay.
Yeah. Their new factory in Shanghai is in the process of ramping up production, which should help alleviate some of these supply constraints. Their residential battery system, the Powerwall, also saw record deployment numbers recently, and they're currently ramping up production of the newer Powerwall 3.
Also supply constrained.
Sounds like it, yes. Even within the solar panel and solar roof market, which has seen an overall market decline, Tesla has been gaining market share in solar inverters and holds the position as the leading supplier of residential energy storage in the United States.
Interesting. So even in a tough solar market, they're doing relatively well.
Right. They anticipate that their energy storage deployments will grow by at least 50% in 2025. However, investors should be aware of a potential headwind. The U.S. tariffs on lithium iron phosphate, or LFP, battery cells imported from China, which could potentially impact the costs associated with their energy business.
Okay, something to watch there. So energy looks like a real bright spot, a growth engine. Now, let's move to the area that often dominates the headlines and investor discussions: artificial intelligence and autonomous driving.
This is absolutely central to Tesla's identity as a technology company and is a key element in many investment theses. Their ongoing work on full self-driving, or FSD, continues to be a major focus.
Right.
They have released new versions of the software, version 13, I believe, and the cumulative miles driven by vehicles using FSD have now exceeded 3 billion.
3 billion miles. That's a lot of data.
An immense amount. The system is continually gaining new functionalities, such as the ability to initiate drives from parked locations and perform parking maneuvers autonomously. They are also in the process of integrating more of their active safety features directly into the FSD software architecture. For a potential investor, the progress and adoption of FSD are critical to watch, as its success could significantly boost Tesla's software and services revenue.
But the rate at which customers are actually purchasing FSD has historically been quite low, hasn't it? I mean, it's expensive.
It has been, yeah. A 2021 survey indicated a global take rate of around 11%. While Tesla doesn't regularly disclose more recent overall figures, they did report $326 million in FSD-related revenue in the third quarter of 2024.
Okay, so it is generating revenue.
It is. However, many analysts believe that as the technology matures and regulatory landscapes evolve, the take rate could increase substantially in the future, which would have a significant positive impact on their profitability and potentially justify, higher valuations.
And then there's the big one that gets investors really excited and maybe a little nervous: robotaxis. That's been talked about for years.
It has, and it's indeed a central element in the more bullish investment cases for Tesla. They have announced a planned launch of their Robotaxi service in Austin, Texas, slated for June 2025.
June 2025, that's very soon.
It is an ambitious timeline. Furthermore, they're actively developing a purpose-built Robotaxi vehicle, often referred to as the Cybercab, with volume production targeted to begin in 2026. Some analysts are forecasting substantial future revenue and very high profit margins from this potential business segment. For an investor, the key question is the feasibility and timeline of this ambitious endeavor.
But there must be some significant roadblocks and uncertainties surrounding robotaxis, right? I mean, regulation alone seems huge.
Absolutely. There are substantial challenges to overcome. These include navigating the complex and still developing regulatory frameworks around autonomous vehicles in different regions, addressing significant safety concerns and public perception.
Yeah, public trust is key.
Definitely. And facing increasing competition from other companies actively developing autonomous vehicle technologies, such as Waymo and Mobileye, as well as the advanced driver assistance systems being developed by Chinese automakers. Tesla also has a track record of, missing its own ambitious timelines for the deployment of advanced FSD capabilities. Investors need to carefully assess the likelihood and speed of regulatory approvals and technological advancements in this space.
And to handle the immense computing power needed for all this AI development, they have their Dojo supercomputer, right? What's the story there?
Yes. Dojo is their custom-designed supercomputer utilizing their own D1 chips, specifically architected for the massive computational demands of training their AI models for FSD and their other AI initiatives.
So it's built specifically for training their driving AI?
Primarily, yes. The main goal is to significantly accelerate the processing of the vast amounts of video data collected from their fleet of vehicles, thereby speeding up the development and refinement of their autonomous driving capabilities, and importantly, reducing their reliance on third-party hardware suppliers like NVIDIA.
Ah, vertical integration again.
Exactly. They significantly increased their AI training compute capacity in 2024, and they have future generations of the Dojo architecture in the planning stages. Dojo is also seen as a critical infrastructure component for training the AI that will power their Optimus robot and potentially even for offering AI as a service to other businesses in the future.
AI as a service, interesting.
Yeah. For an investor, the development and deployment of Dojo represent a significant long-term investment in their AI capabilities, a potential competitive advantage if it works as planned.
Speaking of robots, let's discuss Optimus. For many investors, this still feels like a very long-term, maybe even science fiction, high-risk bet.
It's certainly in the earlier stages of development compared to their automotive or energy businesses, but Tesla is definitely allocating resources to it. They recently unveiled the second-generation Optimus robot, Optimus Gen 2, which demonstrated noticeable improvements in dexterity and movement.
I saw some videos, yeah. Looked smoother.
It's a hit.
Oh.
They've also released videos purportedly showing Optimus performing basic tasks within their factories, although some have raised questions about the extent to which these demonstrations involve remote human operation or teleoperation.
Ah, okay. So maybe not fully autonomous yet in those demos.
Potentially. It's important to note that the AI intended to control Optimus is being developed using the same core AI foundation as their full self-driving system, suggesting potential synergies in their development efforts.
Right, leveraging the same AI backbone.
Exactly. For an investor, Optimus represents a potentially transformative long-term opportunity, but its near-term impact on the company's financials is likely to be minimal and carries significant technological and market adoption risks.
What's the projected timeline for Optimus becoming a tangible product that could impact their bottom line? When might we see these in warehouses or factories?
Their current plans involve limited production in 2025, primarily for internal use within their own manufacturing facilities. They're aiming to potentially begin selling Optimus robots to other companies by 2026.
Selling them next year? That still seems fast.
It does. Elon Musk's long-term vision is for mass production with a potential target price point in the range of $20,000 to $30,000 per robot. Some analysts foresee this technology as having a potentially revolutionary impact on manufacturing, logistics, and even consumer markets in the longer term. One analyst firm, Wedbush, mentioned a potential $2 billion opportunity just in warehouse automation.
Okay, so huge potential if they can pull it off.
Huge potential, yes. But it's crucial to remember that it is still in the very early stages of development, and there is considerable skepticism among some investors and industry observers regarding its near-term viability and the ambitious timelines being projected.
It's definitely a high-potential, high-risk endeavor. What about some of their more established but perhaps less frequently discussed ventures, like services and charging?
Right. They have a services and others segment, which generated over $2.6 billion in revenue in the first quarter of 2025, showing a healthy 15% year-over-year growth rate.
Okay, decent growth there too. What's included in that?
This category includes revenue from vehicle servicing, sales of used vehicles, merchandise, and an increasingly significant contribution from their insurance business, Tesla Insurance.
Ah, yes, Tesla Insurance. How widespread is that now?
It's now available in 12 U.S. states and utilizes real-time driving data via their safety score, except in California, to determine premiums for most policyholders. Based on carrier results from 2024, projected premiums were already looking to exceed $1 billion.
So, potentially another significant revenue stream based on their data?
Potentially, yes. And their Supercharger network is another substantial and growing asset. As of Q1 2025, it comprised over 7,000 stations globally, with over 67,000 connectors. For an investor, these segments offer the potential for more stable and recurring revenue streams compared to vehicle sales, which can be cyclical.
And they've made a notable strategic decision recently regarding the Supercharger network, haven't they? Opening it up.
Yes, that's a big shift. They have begun opening up their Supercharger network to electric vehicles from other manufacturers. And a significant number of these manufacturers, like Ford and GM, are adopting Tesla's charging plug standard, the North American Charging Standard, or NACS.
That seems like a smart move, turning a cost center into a potential profit center.
Exactly. This strategic shift has the potential to transform the Supercharger network into a major and relatively predictable revenue stream from charging fees paid by non-Tesla EV owners. Goldman Sachs has estimated that this could potentially generate over $25 billion annually for Tesla in the future.
$25 billion annually, just from charging.
That's the high-end estimate, but it shows the potential scale. In 2024 alone, their network delivered a massive 5.2 terawatt-hours of energy, and they are continuously rolling out newer, faster V4 charging technologies. For investors, this represents a potentially significant and relatively stable revenue source that complements their more cyclical automotive sales.
It sounds like even with some of the challenges in the automotive sector, Elon Musk's attention is still spread across a wide range of ambitious projects. What have we heard about his current plans and priorities moving forward? Is he still focused on, say, Dogecoin or back to the core businesses?
Recent reports suggest a renewed focus on his core business ventures, including Tesla, SpaceX, and XAI, after a period where his public engagement seemed more broadly distributed, perhaps less focused on the day-to-day.
Okay.
Within Tesla, the emphasis appears to be heavily weighted towards achieving breakthroughs in autonomy, both with full self-driving and the Robotaxi program, as well as continuing the development and eventual commercialization of Optimus.
So autonomy and robotics are top priorities.
It seems that way. He has reiterated the planned Robotaxi launch in Austin for June 2025, and the target for volume production of the Cybercab by 2026. The Optimus project will continue to see development, with limited production for internal use anticipated this year and potential initial sales to external customers in 2026, all leading towards that long-term vision of mass production.
And the cheaper cars. Still happening.
Yes, absolutely. The plans for introducing new, more affordable vehicle models in the first half of 2025 remain a key priority for driving volume growth in the automotive segment. He also continues to publicly state his conviction that Tesla will ultimately become the most valuable company in the world, which underscores his long-term ambitions for the company's overall impact and market capitalization.
Right, that famous prediction.
For investors, these stated priorities offer insight into where the company's leadership is focusing its efforts and resources, which can inform their assessment of future growth areas and potential returns.
What about his other significant ventures? SpaceX is still aiming for Mars colonization, I believe. That hasn't changed.
Absolutely. The core objective for SpaceX remains the Starship program and the long-term goal of enabling the colonization of Mars, with achieving full reusability of the Starship launch system being a critical near-term milestone.
When might Starship actually get to Mars?
Well, the aim is ambitious. They are aiming for Starship to potentially reach Mars by the end of 2026, possibly even carrying Optimus robots for initial deployment.
Robots first, then people.
Yes. These initial missions are expected to be uncrewed, with crewed missions likely not occurring before 2029 at the earliest. The continued expansion and service improvements of the Starlink satellite internet network also remain a high priority for SpaceX. While these ventures are separate from Tesla, Elon Musk's leadership across these innovative companies can influence investor perception and potentially create synergistic opportunities in the long run.
And with X, the platform formerly known as Twitter and XAI, the strategy seems to be centered around integrating advanced AI into the social media platform, merging the two.
That is the overarching vision, yes.
Yeah.
The plan is to integrate the advanced AI capabilities of Grok with the vast real-time information network of X. They are actively utilizing X's data for training their AI models, and the long-term ambition is for X to evolve into an everything app.
The everything app.
Right. With Grok playing a central and transformative role, potentially even disrupting traditional search engines like Google. Monetization strategies for Grok include integration into the X Premium subscription service and offering enterprise API access.
Okay.
Elon Musk has emphasized that the simultaneous rollout of these critical technologies across X and Tesla is currently demanding a significant portion of his focus. For investors in Tesla, the potential synergies between Tesla's AI development for autonomous driving and robotics and xAI's general-purpose AI ambitions could represent a significant long-term advantage if they materialize.
He's also still involved with Neuralink and the Boring Company, aren't they? Briefly, what's happening there?
Yes. Neuralink is continuing its clinical trials of its brain-computer interface technology, with the initial focus on enabling individuals with paralysis to control external devices using their thoughts. Their longer-term aspirations include restoring other sensory and motor functions.
Pretty groundbreaking stuff if it works.
Absolutely. And the Boring Company is actively expanding its underground transportation system in Las Vegas, known as the Vegas Loop, and has also announced plans for a new, more ambitious Dubai Loop project. While these are separate entities, they reflect Elon Musk's broader ambition to tackle significant technological challenges across various sectors.
So pulling everything together, if someone is considering an investment in Tesla right now, what's the fundamental balancing act they need to consider? It sounds like a lot.
It is a lot. Ultimately, evaluating Tesla as an investment involves carefully weighing the current challenges and uncertainties within their core automotive business, the margin pressure, the slowing growth, the competition against the significant yet inherently risky potential of their diverse technology ventures, particularly in the realms of artificial intelligence, robotics, and energy solutions.
So current auto reality versus future tech promise.
Essentially, yes.
Mm.
There is a wide spectrum of opinions on Tesla's current valuation, ranging from fairly conservative to extremely bullish. And these varying perspectives are heavily contingent on the assumptions one makes about the future success and the timelines associated with these ambitious technology initiatives. For a potential investor, it's crucial to conduct their own due diligence and determine their own level of risk tolerance when assessing these future-oriented aspects of the company.
It's definitely not a simple, straightforward investment decision. It requires a deep dive into a lot of different areas, as we've tried to do here.
Not at all. It requires a comprehensive assessment of both their present realities and their future possibilities across a diverse portfolio of businesses, some of which are still in their very nascent stages of development and commercialization. You really have to believe in the execution of those future plans to justify certain valuations.
So, with all the information we've explored in this deep dive, here's a final question for you, the listener. Considering the current landscape and Tesla's ambitious plans, what single factor do you believe will most significantly determine Tesla's future success and its stock price trajectory? Is it the successful turnaround of their automotive profit margins? Is it the widespread adoption of their full self-driving technology and Robotaxi service? The successful commercialization of the Optimus robot? The continued rapid growth of their energy business? Or perhaps an entirely different factor we haven't even emphasized enough? We encourage you to delve deeper into the specific areas that have resonated with you during this discussion to form your own informed perspective.